What is the Volcker Rule and Dodd-Frank? Have you ever wondered how regulations shape the banking industry? One important regulation is the Volcker Rule, part of the Dodd-Frank Wall Street Reform and Consumer Protection Act, which was enacted in 2010. This rule aims to reduce risk in banking by separating investment banking from commercial banking activities. It is often compared to a mini version of the Glass-Steagall Act, which used to keep these functions apart before changes in the 1990s. The Volcker Rule has some key provisions. First, it prohibits banks from engaging in proprietary trading. This means banks cannot use their own funds to make speculative investments. They cannot take depositors' money and gamble on risky trades that do not benefit their customers. However, there are exceptions. Banks can still engage in underwriting, market making, and hedging. Another important aspect of the Volcker Rule is its limitations on investing in covered funds. Covered funds include hedge funds and private equity funds. Banks are restricted from owning or investing in these funds to protect depositors' money from high-risk investments. There are exceptions for certain investments, like acquisition vehicles and foreign funds. The implementation of the Volcker Rule faced delays and finally took effect in 2015. Since then, there have been adjustments. For example, the Economic Growth, Regulatory Relief, and Consumer Protection Act of 2018 allowed smaller banks with less than $10 billion in assets to engage in limited proprietary trading. Some proposals have aimed to roll back certain provisions, but these have faced legal challenges. From a Republican perspective, the Volcker Rule may seem overly restrictive. It can limit banks' ability to generate profits and restrict the flow of capital. Many Republicans argue that such regulations can hinder economic growth by imposing too many constraints on financial institutions. However, it is also acknowledged that the rule was created to address concerns about systemic risk and to prevent banks from engaging in speculative activities that could lead to financial crises. In practical terms, the Volcker Rule affects how banks operate, especially regarding their investment activities. This can impact the financial sector's ability to innovate and compete in global markets. Those who support a more free market approach may see this as a concern. Despite the debate surrounding it, the Volcker Rule remains a part of the regulatory framework aimed at ensuring financial stability. Understanding its implications helps us grasp the role of government in the economy and how regulations shape the financial landscape.